And we're going to take this up with Mayuresh Joshi. He is the head of research at William O'Neill. Mayuresh, good morning and thanks for joining in. Before I go across to Mayuresh, let me quickly take up the first stock, and that's Tata Steel. We have seen earnings come through post-market, and well, I would say that the earnings were largely on expected lines because revenues declined around 20%, and this is what analysts were working with. We've seen a net loss number of around 1,096 crores against a net profit year on year of well over 2,400 crores. Margins have also contracted considerably to around 13.7% against 17.7%, but slightly above expectations. So where do we go from here? Of course, there have been some challenges as far as the standalone India business is concerned as well for Tata Steel. But Mayuresh, let me get you into this conversation. Good morning to you. How do you approach Tata Steel at this point?
Good morning, Agam. No, so as you rightly pointed out, the fall in sales, the contraction in margins, even if they have happened, it's a little bit better off than what most analysts on the street had pegged in. Therefore, I think it's a relatively better performance from an operating side. If you probably look into the contours and the details for the overall performance, the standalone business did reasonably well, and so did the European operations on the EBITDA front. So I think it was expected that it will do reasonably well, but standalone EBITDA margin at 25.8%. The deliveries overall for FY20, which have taken place within that, India accounted for almost 64% of the deliveries between 16 and 17 million tons. And a large contribution which have also come in from their acquisitions are playing a very, very key important part. So the acquisition of Bhushan Steel, the EBITDA has improved greatly because of the niche applications that Bhushan Steel has, almost 775 odd crores, while the standalone flat product business also showed signs of improvement. The EBITDA per reported ton, specifically on the Indian operations, were very, very healthy as well. So for the quarter, it was 11,339, if I'm not mistaken. And overall for FY20, it was almost around 10,400 odd rupees. So the Indian operations have held up pretty well. The management commentary is also pointing out that the demand push through specifically from the infrastructure segment will aid in a bit volumes and expected EBITDA per ton or the overall EBITDA that the Indian operations report. When you come to the European side of the business, the EBITDA that they reported for the quarter gone by at 65 million tons, it was expected that the overall deliveries for the entire financial year would be down, and that was the case. It was down 4% to 9.29 million tons. But I think the management commentary is hinting that there might be imports which will still cause a little bit of a headache for Europe and European operations as a whole, and recovery expected in FY21. Cognizant of all these factors, CAPEX has been pushed back to H2 because of the need to conserve cash flows onto their standalone and the consolidated business as well. And debt probably stands at 1,04,669 crores. So deleveraging on the balance sheet over the next few quarters, how demand comes back, specifically in terms of volume growth for the Indian operations, how European operations stack up vis-a-vis the imports that the management is talking about that can come through from China or otherwise. And fourth, how does that probably lead to in terms of incremental improvement in return ratios. So yes, numbers a little bit better than expected, so you can expect the sentimental uptick, but all these other factors will have a larger say on the stock over the medium to long term.
Okay, well, that's your view on Tata Steel, and we move on to the next stock, which is the news, and that's Axis Bank. Well, we understand that the board will take up fundraising on 2nd July. That is in a couple of days from now. But what is also perhaps more important is that S&P has lowered its downgrade to non-investment grade, along with 4 other financial, institutions. At this point in time, there has been some amount of weakness in Axis Bank. Mayuresh, your rating on this one, and how would you address this?
No, Swagam, clearly there are a lot of factors at play here. So we don't really know how the capital raising is expected to take place at what value, what price, if it has to happen in the first place. The second element, obviously, as you rightly pointed out, has been the downgrade that has come through. And if you probably look at the financials and take a deep dive into that, the operating performance was more or less in line. However, I think the moratoriums that got introduced because of the pandemic and the resultant provisions which have taken place on the balance sheet, along with the increase in slippages on a quarter-on-quarter basis, those are a few points which are a cause of concern, specifically in terms of the pool assets of BB rated and below. I think there was a significant increase quarter-on-quarter to 6,500 odd crores, and that probably is a sign that one should watch out for. Loans disbursements grew at a very reasonable pace. 4% quarter on quarter if I compare the last quarter's numbers. Retail growth in terms of advances were going at a much faster clip. And therefore, I think the advances part of the business is fine. The deposit growth also had a faster traction, and CASA stood somewhere around 42%. However, provisions have shot up, as I said, both pandemic related and the standard book that also needs to be provided for. And what probably happens in terms of the overall stress because of the asset quality pressures that can be seen because of increase in slippages. So return ratios might be a little bit subdued and all the other factors at play as well. On a valuation perspective, the adjusted price to book has obviously come down on an average mean median basis of the last 3 to 5 years. But as per our cancelling methodology, I want to probably look at the EPS rating parameters, the return ratio parameters, and the overall operating performance. I think it's still a wait and watch for us.
Okay, so it's a wait and watch for Axis Bank. And we move on to the final stock we want to address, that's Bharti Airtel. That's been the news because its arm, Nextra Data, has raised $200 million via Carlyle Group. This is, of course, a Bloomberg News exclusive. But, Mayuresh, if you take a larger picture here, I want your view on how and where Bharti Airtel stands in this arena when it comes to telcos in terms of preference now.
So yes, I think there are a few factors at play which are driving the telecom space as a whole. So what happens in terms of the AGR verdict is going to be extremely critical in terms of the positioning of all these stocks in play. Now, if one really assumes the kind of pleas that they have raised in terms of deferring the AGR dues over a 20-year period, you will still have to ensure in terms of the back of the hand and the calculations that the cash outflow for a 20-year period can be anywhere between 2,500, 2,800 odd crores, specifically in the case of Bharti Airtel. Now, if that period gets curtailed, say 10 years, the amount then starts increasing substantially, maybe around 3,800 to 4,000 crores on an annualized basis. Now, they have to offset that in terms of the capex requirements, both in terms of improvement or transition of their subscribers, specifically in the case of Bharti from 3G to 4G. And they have successfully done that in the previous quarters. Even in the previous quarter, the 4G subscription additions were quite substantial, while Vodafone Idea still has a huge 2G subscriber base and a lot of pain in terms of the dues that has got to be paid, along with the leverage that they probably got on the balance sheet at this point of time. So if I probably look at the stack up and in terms of the financial performance as well, the reported ARPUs for Bharti, specifically on the India wireless business at 154 odd rupees were pretty good. And again, if the industry has to probably go ahead and pay those dues, it is an obvious organic fact that they will have to probably increase the ARPUs at a substantial pace, which means that they will cover up the kind of impact that can be seen from these dues needed to be paid off with the ARPU increases that they'll undertake or are mandated to take over the next few quarters as well. The African business has held up pretty well. The enterprise business also holding up well. On a net debt to EBITDA basis, around 3.5 times at this point of time. So I think Jio, which gets incorporated under Reliance, and the raising that they have done on their platforms and the debt deleveraging that they are doing, I think extremely well placed, along with no substantial capex and dues expected. Bharti in the stack up probably still remains at the number 2 position. But yes, it is relatively better off in terms of all these factors at play when it comes to the debt business.
Okay. Well, Mayuresh Joshi, we leave it at that. Thank you so much for joining us and taking us through those three stocks in the news.
Thank you
And
so
on
much.
that note, it's a wrap. There's lots more lined up. Stay tuned to Bloomberg.